A market crash is a sudden and sharp drop in stock prices. It can happen in a matter of days or even hours, causing widespread panic among investors. The speed and severity of these crashes can be alarming, often leading to significant financial losses for those caught unprepared. Think of it like a flash sale, but instead of shoppers, it's investors selling stocks rapidly. This mass selling is usually triggered by fear and uncertainty, causing a chain reaction. As more and more investors rush to sell, the prices of stocks plummet even further, creating a vicious cycle of panic and loss. This fear-driven selling leads to a domino effect, pushing prices down further. Each sale triggers another, much like a row of falling dominoes. The initial trigger could be anything from poor economic data to geopolitical tensions, but once the selling starts, it can be hard to stop. Several factors can trigger a crash. Economic recessions, bursting asset bubbles, and unexpected global events can all spook investors, leading to a sell-off. For instance, a sudden increase in interest rates can make borrowing more expensive, reducing consumer spending and business investment, which in turn can lead to a market downturn. Unexpected global events such as natural disasters, political instability, or pandemics can also cause market crashes. These events create uncertainty and fear, prompting investors to sell off their assets in a bid to minimize potential losses. The rapid dissemination of news in today's digital age can amplify these effects, as information spreads quickly and widely. Remember the dot-com bubble burst in the early 2000s? That was a classic market crash. The rapid rise and subsequent fall of internet-based companies led to massive losses for investors who had poured money into these seemingly promising ventures. That was a classic market crash. It serves as a stark reminder of how quickly market sentiment can change and the importance of being cautious with speculative investments. Crashes are unpredictable and can be unsettling. They often come with little warning, leaving investors scrambling to protect their portfolios. The emotional toll can be significant as people watch their hard-earned savings dwindle in value. But remember, they're a natural part of the economic cycle. Markets go through periods of growth and decline, and crashes, while painful, are a part of this process. Understanding this can help investors stay calm and make more rational decisions during turbulent times. Understanding the causes and potential impact of a market crash can help you prepare and navigate these turbulent times. By staying informed and having a well-thought-out investment strategy, you can mitigate the risks and even find opportunities in the midst of a downturn. Financial advisors and educational resources can provide valuable guidance, helping you to make informed decisions and maintain a long-term perspective. Remember, while market crashes are challenging, they also offer lessons and opportunities for those who are prepared. One of the smartest moves you can make in your financial journey is to build a solid emergency fund. This is not just a recommendation, it's a necessity for anyone looking to secure their financial future. An emergency fund acts as a financial buffer that can protect you from unexpected expenses and financial hardships. Think of it as a safety net that catches you when life throws you a curveball. This is your financial safety net, especially during a market downturn. When the economy takes a hit, having an emergency fund can make all the difference between staying afloat and sinking into debt. Aim for 3 to 6 months' worth of living expenses in a readily accessible account. This means having enough money to cover your rent or mortgage, utilities, groceries, and other essential expenses without having to rely on credit cards or loans. This cash cushion acts as a buffer during job loss or unexpected expenses. Imagine losing your job or facing a sudden medical emergency. Having an emergency fund ensures that you can still pay your bills and take care of your family without added stress. It prevents you from being forced to sell investments at a loss to cover essential needs. Selling investments during a market downturn can be detrimental to your long-term financial goals. An emergency fund allows you to keep your investments intact and avoid making hasty decisions. Having this financial peace of mind allows you to ride out market volatility without making rash decisions. When you know you have a financial cushion, you can stay calm and composed, even when the market is turbulent. Remember, cash is king during uncertain times. In a crisis, having liquid assets that you can easily access is invaluable. It gives you the flexibility to handle emergencies without disrupting your financial plans. It provides stability and flexibility when you need it most. Whether it's a car repair, a medical bill, or any other unexpected expense, an emergency fund ensures that you can handle it without derailing your financial progress. Start building your emergency fund today if you haven't already. The sooner you start, the sooner you'll have the peace of mind that comes with knowing you're prepared for whatever life throws your way. Even if you can only save a small amount each month, it will add up over time and provide you with a financial safety net. Consider setting specific financial goals to help you stay on track. For example, you might aim to save $1,000 in the next 3 months, and then gradually increase your goal as you become more comfortable with saving. Utilize tools like budgeting apps or spreadsheets to monitor your progress and make adjustments as needed. These tools can help you stay organized and motivated as you work towards building your emergency fund. Celebrate your milestones along the way. Reaching your savings goals is an achievement worth acknowledging, and it can motivate you to continue building your financial security. Look for high-yield savings accounts to maximize your savings. These accounts offer higher interest rates than traditional savings accounts, helping your emergency fund grow faster. Automate your savings to make the process easier. Set up automatic transfers from your checking account to your emergency fund so you can save consistently without having to think about it. Having an emergency fund brings a sense of relief and security. Knowing that you have a financial cushion can reduce stress and allow you to focus on other important aspects of your life. An emergency fund is just the beginning of your financial journey. Once you have a solid emergency fund in place, you can start focusing on other financial goals, such as investing for retirement or saving for a major purchase. Building an emergency fund is a crucial step towards financial independence and stability. It empowers you to handle life's uncertainties with confidence and ensures that you're prepared for whatever comes your way. So, take the first step today. Start building your emergency fund and secure your financial future. Your future self will thank you for the peace of mind and security that comes with being financially prepared. Don't put all your eggs in one basket. Diversification is key to managing risk in your investment portfolio. Spread your investments across different asset classes like stocks, bonds, and real estate. Within each asset class, diversify further. For example, in stocks, invest in different sectors like technology, healthcare, and energy, and across various geographies. This strategy ensures that if one area performs poorly, others can potentially cushion the blow. Diversification is like having a financial safety net. It helps mitigate losses and smooths out the ups and downs of the market over time. A well-diversified portfolio is your best defense against market crashes. Market crashes can be emotionally charged events. The sudden drop in stock prices can trigger a wave of fear and anxiety among investors. It's a natural human reaction to feel stressed when you see your investments losing value rapidly. The media often amplifies this fear with sensational headlines and dire predictions, making it even harder to stay calm. But it's during these times of market turbulence that keeping your cool becomes most crucial. Fear and panic can lead to impulsive decisions that harm your long-term financial well-being. When the market is in free fall, it's tempting to sell off your investments to cut your losses. However, these hasty decisions can lock in losses and prevent you from benefiting from future market recoveries. It's important to remember that market downturns are a normal part of the investment cycle. Historically, markets have always rebounded over time, rewarding those who stay the course. It's crucial to keep a cool head and not let emotions dictate your investment strategy. One effective way to manage stress during market crashes is through mindfulness and meditation. Taking a few moments to breathe deeply and clear your mind can help you regain perspective. This mental clarity allows you to make more rational decisions rather than reacting out of fear. Remember, your investment strategy should be based on careful planning and long-term goals, not short-term market fluctuations. Remember that market crashes are often driven by irrational behavior. When investors panic, they tend to sell off their assets en masse, driving prices down even further. This creates a self-fulfilling prophecy where fear begets more fear. By understanding this dynamic, you can avoid getting swept up in the hysteria. Instead, focus on the underlying value of your investments and the reasons you chose them in the first place. If those reasons haven't changed, there's no need to panic. When others are selling in a frenzy, it's easy to get caught up in the moment. The sight of plummeting stock prices and the sound of frantic news reports can be overwhelming, but it's important to remember that these are short-term reactions. The true value of your investments is not determined by daily market movements, but by their long-term potential. By staying calm and focused, you can avoid making costly mistakes that could derail your financial plans. Take a deep breath, step back, and remind yourself of your long-term financial goals. Your investment strategy was designed with these goals in mind, and a market crash doesn't change that. By keeping your focus on the bigger picture, you can navigate through the turbulence with confidence. Review your financial plan and remind yourself why you invested in the first place. This can provide reassurance and help you stay committed to your strategy. Instead of making hasty decisions based on fear, focus on the fundamentals. Look at the financial health of the companies you've invested in. Are they still profitable? Do they have strong management teams and solid business models? If the answer is yes, then there's no reason to panic. Market downturns can actually present opportunities to buy quality stocks at discounted prices. By focusing on the fundamentals, you can make informed decisions that align with your long-term goals. Look for buying opportunities that may arise during market downturns. When stock prices are low, it can be a good time to invest in companies with strong fundamentals. This strategy, known as buying the dip, allows you to acquire valuable assets at a lower cost. However, it's important to do your research and ensure that the companies you're investing in are financially sound. By taking a disciplined approach, you can turn market volatility to your advantage. Remember, successful investing is about discipline and patience, not emotional reactions. The most successful investors are those who can stay calm during market turbulence and stick to their long-term plans. By maintaining a disciplined approach, you can avoid the pitfalls of emotional decision-making and achieve your financial goals. Patience is key, as markets will inevitably recover over time. Trust in your strategy, stay the course, and you'll be well positioned to weather any storm.